Aloha, and welcome to the Sylvan Bell Business Growth and Exit Strategy Podcast, your guide to building companies that command maximum multiples. I'm Sylvan Bell, author of 5 books on business strategy and sales, creator of the Sell Framework, Scale Framework, and Driver Test. I work with owners of $10 million to $250 million companies, whether you're scaling for growth or positioning for a profitable exit. Each episode breaks down one framework, strategy, or concept you can apply this week to grow revenue systematically, scale operations, and maximize enterprise value. Let's get started. Welcome to episode number 43, how buyers calculate business valuation, what your EBITDA multiple really means. Hey, it's your money. You should know how much you're going to get paid. And when you take a look at a deal based upon your seller's thesis or your Titan's thesis, you should be able to say, hey, this is suboptimal. This is about right. Or I'm shooting for the max multiple because I want an A+ deal. I do have to throw in this disclaimer for you. I'm not a doctor, attorney, marriage counselor, or therapist, and your results may vary. So I'm going to give you ranges. I'm going to give you ideas. I'm going to give you some strategies. But at the end of the day, this will help you have the conversation, but you really do want to have a one-on-one with a qualified professional and not take this as legal advice or investing advice. Now that fun is done, let's start with question number 1. How do I find out what my business is actually worth before I talk to a buyer? All right. There's guides and resources for you that post this information. And so what happens is if you're above the $10 million in revenue and up to $250 million, you're going to be basing your sell off of EBITDA, which is a fancy word for profit. And so sources like BVR, the Business Valuation Report, or PitchBook, or a couple of other places publish what valuations could be. Now, valuations fluctuate by the quarter, and they change over the year. The reason why this is important is you want to be ready in advance for your timing. This is why having a 5, 4, 3, 2-year plan allows for you to be flexible. It also allows for you to make sure that your client concentration or customer concentration isn't too much, and you don't have owner dependency. So if you say, hey, Scott, what are those 2 things? Well, client concentration is this. If you had 10 clients and one client made 50% of your business, that's a huge red flag. That's a building size red flag. Most private equity, most private investors, most investor groups don't really want to see one client over 20%, preferably like 10. Okay. So you're going to want to take a look and figure out how do I maximize the people that I do business with so that if one leaves after the sale is made, I don't get dinged and dented. And then owner dependency is pretty straightforward. Can you leave for a long period of time, and can the company run without you? You really want to work on knowing what your multiples are and track them over quarters and look for that optimal time for you to exit. What's the difference between what I think my business is worth and what a buyer is willing to actually pay? I want to take you through a couple of scenarios because they're going to matter. Your business is worth what it's worth. And so what will happen sometimes is you may hear multiple. And let's say that you're having a $10 million year and you hear a 4 multiple. Well, you're thinking, I'm going to get paid $40 million for my company. That's one way it can be calculated. That's not the normal way. But there are strategic buyers that will invest in a company in the way that I just outlined. Typically, what happens is an investor, private equity, or investment group comes in and says, let's talk about EBITDA, earnings before interest, tax, deductions, and amortization. And then we're going to multiply that times your multiple. So if you have a $10 million business and you're doing $1 million in profits or EBITDA, that's going to give you on a 4 multiple, $4 million. On a 6 multiple, it's going to give you $6 million. Where that changes is where you have an exceptional company, where you have what I call a Titan's thesis. And what it is you are the best of the best in the market and you have proof. When you have proof and you have history, you can get more for the valuation of your business. And you can take that and auction it, so to speak, to the people in the industry or the service that you offer. So if you have an A+ level company, you could take a look at it if the timing is right and get 130, 140% of what the market typically pays because it's a platform company. If you have an A-level company and it was a 4 to 6 multiple, you could probably get that 6 multiple. If it's a B-level company, you're probably going to get a 5. It's a C-level company, you're going to get a 4. and it's a D level company, you're probably, if you hopefully going to get a 2. Now, does it always work out that way? No. I'm just giving you some ranges so you can say, oh, well, this makes sense, and I could take a look at it. The leverage for you comes from your history, your client concentration, and the no need for owner dependency. And so when you start taking a look and you start putting these items together, it gives you a compounding effect. I've talked to business owners that think that their company or business is worth $100 million because that's what they think it's worth. And that's the number that they want when they exit. But nobody's going to pay them that number because in a lot of times those companies are worth 10, 20, $30 million. But you've got blood, sweat, and tears put into a business. So sometimes it's not the math that you're thinking through, it's the emotions that you have. So when I say the numbers can range all over the place, it's really going to come down to when you take a look and you run the math and you look at the ratio and you figure out, hey, what's somebody willing to pay? It's going to come down to EBITDA and profitability times a multiple, like 4 to 15, depending upon how big your company is. And if you have the capability of being a platform company. This is one of the reasons why I created the Exit Ratio 360, the book on how to score your business, so that you can hunt for what you're going to consider the maximum multiple, so that you can document when you know that your business is ready. How does EBITDA affect the valuation of a mid-market business, and how do I improve it? EBITDA is always going to come down to the primary driver of valuation because most mid-market businesses are valued as a multiple of EBITDA. Occasionally, it could be a multiple of revenue. That's not always going to happen. If it was a small company without professional management, it would be seller's discretionary earning. You're typically going to work in the range of EBITDA. The higher and more stable your EBITDA, the higher your valuation could be, depending upon the timing of the market and what the buyer's looking for. Buyers really want consistency, margin strength, and predictability of earnings. You improve the EBITDA, you improve your pricing power. You're going to look to cutting inefficiencies and eliminating unnecessary expenses. And the real leverage for you comes from improving both margin quality and sustainability, not just boosting short-term profit. What's a valuation multiple, and how do I know what multiple my business deserves? There's going to be a couple of answers to this question. And what it's going to come down to is your profits, your EBITDA, your earnings before interest, tax, deduction, and amortization. And then what's going to happen is there is a number in the market based upon the business valuation report, based upon pitch book, based upon how hot the industry product or service is, how much the private equity or the private investor needs your company, is really going to determine what valuation you're going to get. One company can give you one number greater than the other. And this is why you want to talk to multiple buyers across the spectrum and have a Titan thesis ready. And a Titan thesis is this. This is your company's history, and it's also proof of why you deserve an A+ level multiple or why you deserve to be a platform company. And when you're taking a look, you want to plan this out 5, 4, 3, 2 years in advance, 2 years minimum, right? So if you do a 5-year plan and you put all the work in the front 2 years, you have 3 years to make your decision of when do I want to strategically exit my business? Because as interest rates move up and down, as the markets move up and down, a number today of a 10 multiple could be a 5 or a 3 tomorrow, depending upon what's going on in the industry, depending upon what's going on in the service, depending upon interest rates. So it's not just licking your finger and sticking it in the air and saying, I hope I get this. It comes down to your history and it comes down to your profits. How do I increase my business valuation in the 24 to 36 months before I go to market? You want to focus on increasing the EBITDA, the earnings before interest, taxes, deductions, and amortization, while also improving the quality of the EBITDA. You want to absolutely reduce the owner dependency. You want to start taking some trips and vacations and making sure that your management team can make decisions while you're gone. This is really going to help you out because as you go to sell your business, one of the questions that's going to be asked is, how dependent is the management team on you to make decisions? And if you are the decision maker, they're going to say you're going to have to stick around. You don't want that. You want the beach style retirement that, like, when you get paid, you can leave. And if they need something by chance, they can call you on the phone. That's the dream retirement. That's the barefoot lifestyle. It's the barefoot retirement. That's what you really want to do. You want to lock in reoccurring revenue where you can. Sign up contracts that are extended and have a bite where somebody is locked in for a certain amount of time after the purchase is made. Most of the time, companies, private equity are going to look for 1 to 5 years, depending upon the industry or service. And you want to make sure that everything's professionally presented. You want to diversify your client base and eliminate concentration risk. You really don't want to have one client be more than 10 or 15% of your entire business. Because if they leave after the sale, you're going to get dinged and dented, meaning there's going to be money and holdbacks that you're not going to get paid. You want to make your business easier to buy, easier to scale, and easier to trust. What kills a business valuation faster than anything else when preparing to sell? Here's what you're going to find. Uncertainty in a business in the future is a risk that will destroy valuation faster than anything. It'll drop like a rock. Inconsistent earnings, messy financials, lack of documentation. These are all major red flags. These are building size red flags. Client concentration and owner dependency comes up in just about every conversation when somebody loses multiple and loses valuation. What you want is to have confidence in the business. What you want is somebody to come in and say, hey, we can run this thing without the owner. There's zero owner dependence. That's the best way to get a company prepped to sell. Legal issues or unresolved employment issues will kill deals entirely. I've seen deals get to the 1 yard line, only to find out that there's an employment issue that was held off to have a conversation till the very end because the hope was it could be fixed before the deal was done. And I've seen 18 months of work just evaporate because the hope was that somebody was going to sign an agreement and get a paycheck and everything was going to be good. And the person held back. They knew the company was for sale and they were demanding more money and demanding more money. And ultimately, the buyer said, there's other companies out there with less drama. How does owner dependency reduce the sale price of a mid-market business? If the business relies upon you, you got a job. In all realities, it should be your general manager or your ops manager or your COO, your chief operating officer that's running everything, because a buyer wants to look for continuity. They want to make sure that after the sale is made, that company is going to run without you, and it's going to run fine. Especially if it's a large private equity firm and they've got companies across the United States or the world, they're going to manage via spreadsheets. They're going to manage via Zoom or Google Meet calls or anything similar that's out there in the future. And if everything relies upon you, you're not going to be able to walk away from the sale. They're going to do a time holdback. So it could be 3 months. It could be 6 months. It could be 12 months. The more uncertainty and the more risk in a deal, the more conditions that are put on it. And when you have owner dependency, and that's something that is real, then the conditions that are going to be put on your deal are not ones that you want. So it's better for you to take a look at something like the Exit Ratio 360 book and plan out your process. And let's just say for a second you decide, hey, Scott, I don't want to sell. Okay, that's fine too. Make your company more profitable. You're going to find that you enjoy it more. You're going to find that if you have everything in place, it makes it easier for you to go into the office and have conversations. What's the difference between enterprise value and equity value when selling a business? Enterprise value is the total value of the business before debt and cash adjustments. Equity value is what you actually take home after debts are paid and the adjustments are made. The formula is simple. Enterprise value minus debt plus cash equals equity value. Sellers focus on headline numbers and overlook what they'll actually receive at closing. Understanding this difference prevents surprises during negotiations and deal structures. One of the things that I see people who are after their maximum multiple do is they know their numbers backwards and forwards. They know their profitability, they know their quality of earnings, they know how the company operates. And so there's going to be a point where you sit down at the negotiation table and Excel Eddie is the guy who is fantastic at doing spreadsheets and his cousin Spreadsheet Steve. They're going to sit down and they're going to tear apart your business. And they're going to look for every inconsistency that they can find. And when you take a look at enterprise value and equity value, those numbers can mean the difference between you going to the beach for a vacation or living on the beach for life. So you really do want to get this worked out. How do customer concentration issues affect business valuation, and what can I do to fix it? All right. If you have a group of clients and you take a look and you start figuring out who is your biggest client, the number that they teach in business school is you really don't want to have a client more than 20% of your book of business. So if you're doing 10 million a year, 20% is 2 million. If you can get client concentration down to 10% or less for each client, there's magic that can happen from the buyer because they have less risk after the sale. The worry is this: you sell your business and the word gets out and everybody wants out. They cancel. Well, they're going to come back and say, hey, we paid you based upon future earnings, and now that those clients have left, we want some of our money back. That happens in just about every single deal. I will share with you the only time that I have seen this not happen is when somebody says, hey, I see that you want to pay me $10 million. I want all cash right now with no holdbacks. So the private equity firm, the investment group, the buyer's group says, we'll give you $7 million cash right now. We'll give you $9 million cash today and $1 million holdback, or you can walk with $7 million today with no holdback. They're going to discount the value of the company. And it may not be exactly the way that I explained. I'm using simple math to make it as easy as possible for you. The one thing to remember is that you can expand into new markets or segments. This may help if you can prove that that client is going to stick around or that it's a profitable line of business. The goal for you is to spread revenue across multiple reliable sources, so you're not just hoping that one's going to stick around. What's a quality of earnings report, and how does it change my valuation number? All right, a quality of earnings report is a deep dive into your books, and depending upon the size of your business, it could take a month or 6 months to create. And what's going to happen is there's going to be a team that validates your financials, and it's going to remove uncertainty. It confirms your EBITDA, identifies your add backs, and highlights the risks that are in the business. Buyers rely on it to justify their offer because they may need to get underwriting on the offer. There may be subjects to the money that they're taking for the deal that's going to say, hey, we need to know that this is underwritten by a major firm and that a CPA signed off on it and said the quality of earnings is right. A strong report can support you getting the maximum multiple or a better A+ deal. A weak report can mean that you're getting a B- or a C deal. So it's important for you to pay attention to what is going on with your quality of earnings and the report that you get from it. A weak one can delay the deal or just shut it down entirely. How do recurring revenue and contract-based revenue affect the multiple a buyer will pay? Deals come down to certainty and risk. And when you have recurring revenue, whether it's monthly recurring revenue or contract-based recurring revenue, it signals that people are willing to keep paying. And one of the things that I suggest that a company does, and if you need to talk to a qualified person about this, is to take a look at your contracts 5 years, 4 years, 3 years, 2 years before you go to sell and make some changes in when they automatically renew and what it takes to renew a contract. And that maybe it's a good idea to put an automatic increase in pricing in a contract every year, because in that way you're not having to call or send a really nice letter that says we want more money. And you can tie these numbers to a specific percentage or a specific amount and say, hey, listen, what you need to know is this is what it's going to be today, and it automatically goes up a year from now, and then it automatically goes up another year, because we have this thing called inflation, and we have this thing called price adjustments. So it's an automatic thing. And if you have that conversation and your sales team has that conversation from the very beginning, you now have some reoccurring revenue that's tied to a real number that you can go to private equity or an investor and say, we've already thought of this. Because what happens is somebody can look at the deal and say, we like your deal, but there's some uncertainty here, so we're going to put some holdbacks in place because we're going to do a price increase. So if what you need to know is if you're not willing to do a price increase, private equity is going to, your buyer is going to, your investment group is going to come in and say, hey, we're going to right size whatever amount this needs to be. So you might as well get the yield from it You might as well get the money from it before, and you might as well get the money after. How do I normalize my financials to show a buyer the true earning power of my business? Normalizing the financing means that you're adjusting the numbers to reflect the true operational performance of the business. You're removing the one-time expenses, the personal expenses, and the non-reoccurring events. You're taking out what I'm going to refer to as the fluff. You're taking out what I'm going to refer to as the cream. And the goal for you is to present a clean, accurate picture of ongoing earnings and take the time to say, hey, look, this is the way that the company really operates. You want to spend some time to document the process so it's clear for a buyer and it's logical without skepticism. They're going to dig into it. So you do not want to make stuff up. You may want to hire your own firm to do a quality of earnings report and figure out and say, hey, listen, I've already done the work and it's already signed off by a CPA. And it's from a large firm. It's not from somebody who does this in their garage. That person can be held accountable if the quality of earnings report is off. And message from your sponsor, Scott Sylvan Bell. That's me. If you're getting value from this episode, here's how to go deeper. First, subscribe to my weekly newsletter, The Party, at scottsylvanbell.com. That's where I share the strategies, frameworks, and case studies I don't release anywhere else. You'll get one actionable insight every week you can implement inside your business immediately. Second, while you're on the site, download the complete Sell Framework, Scale Framework, and Drivers Test, all free with scoring guides, worksheets, and step-by-step implementation checklist. These are the same frameworks I use with $10 million to $250 million companies to build systematic revenue, scale operations, and maximize enterprise value. Go to scottsylvanbell.com right now, subscribe to the newsletter, grab the frameworks, and let's keep building companies that command maximum multiples. Let's get going. What's an add back and how do I use it to increase my adjusted EBITDA before going to market? One of the things that you're going to find is this is a common conversation of what belongs in profitability and what doesn't. And an add back is an expense that you remove from your financials because it's not essential to future operations. You have common examples that include owner perks, excessive compensation, one-time cost. Proper add backs increase adjusted EBITDA. I've seen deals where people try to add back just the insane amount of things that aren't accurate. And it works to their favor until somebody digs into the books and says, hey, listen, we got to right size this deal. We've got to take a look. We understand that there's going to be add backs, but you went excessive in this. And sometimes, depending upon how it's done, it can erode trust. So yes, your company, your business, your practice right now has valuable add backs that you should do. But should you try to cram anything and everything in there? No, because it's going to signal that you're trying to take advantage of a deal. It's going to signal, hey, there might be other problems in this deal. And you're going to get picked apart. They're going to look at them, the private equity, the investment group, the private buyer is going to look at them and says, I'll accept these, but I'm not going to accept those. It's going to come down to a negotiation. And I've seen deals go sideways because the owner, the founder, tried to add back too much. And it was like, this just doesn't work. And I've talked to other investors and they say, hey, when I start seeing excessive add backs, I start looking at the deal with more and more scrutiny. It's a sign, and I'm pointing at the sky. It's a sign from the business gods. There may be more issues. How does having a strong management team affect what a buyer is willing to pay for my business? Owner dependency is your worst enemy when it comes to your valuation. And if you can be away from your company for an entire quarter and it runs profitably without you or better than when you're there, that is a signal to the buyer that that's a business that they want. And so one of the things that I absolutely work on with my clients is on a 5-year, 4-year, 3-year, 2-year plan, when we're saying, hey, we're going to look at what it's going to take to sell your business and shoot for the maximum multiple, because it's not a promise that you're going to get it, but we're going to shoot for the maximum multiple, is that you start taking more time off. You start taking more vacation. You start giving your management team decision bands. And a decision band is this. Your chief operating officer can spend $100,000 without asking. Your general manager can spend $50,000 without asking. Either one of those people could hire or fire a will. Your supervisors can spend $5,000 without asking. I'm giving you random numbers, but a decision band is lined out in your job description, your org chart, your standard operating procedures of what people can do. Because if you can turn your keys over on the day that you sell and say, call me if you need anything, and then they never have to call you, that is the dream deal for a buyer, for private equity, for an investment group. Because there's not a lot of risk. The knowledge that you need is all transferred. It's in the head of the person that's going to be running the business. Now, here's the other thing. What you don't want to have happen is this. You sell your business, you haven't transferred the knowledge, so you've got to stick around for 3 months, 6 months, 12 months, tied to a number, and teach the person who was underneath you what you need to do. And oh, by the way, now they're your boss. When I explain that to owners and founders, they're like, no, I haven't had a boss in years. It's my company. Well, then it's important that that person who's going to take your place knows what needs to be done so that they are not your boss later on down the road. What's the valuation gap and how do I close it before I list my business for sale? So the valuation, the gap is the difference between what you believe your business is worth and what buyers are willing to pay. You want 10 million, they're going to pay 6. There's a $4 million valuation gap. And so the valuation gap can come from phantom numbers where you just pull the number out of the air. It can come down to risk factors, weak financials, crazy unrealistic expectations. To close it, you increase your performance, reduce perceived risk. That's client concentration. That's dependency upon you being a founder. That's monthly recurring revenue. That's quality of earnings. A well-prepared business with a tightened thesis narrows the gap and it increases your negotiation leverage. You don't want to sit down at the table and not have leverage. You didn't spend this amount of time, effort, and energy building your business to get the least amount of money possible. You want somebody who says, hey, the market pays 7 times multiple. You're in such a good position. We want to give you 11. Totally made up random numbers. I can't make a guarantee that that's going to happen to you. But when you have the history of your company and you have a tightened thesis, it is more likely. How do documented systems and standard operating procedures or SOPs affect the valuation of a mid-market company? Documentation in your systems is key because you're transferring business knowledge. Buyers see this as reduced risk and a smoother integration. And integration, if you don't know, that's when two companies need to talk and figure out how do we work together? What software are we going to use? What decision-making process are we going to use? What management style are we going to use? And when you have standard operating procedures, they can go in and look and say, hey, this is either a really good fit or we're going to have to bring a team in and we're going to have to get some work done to make the integration work. You want increased confidence because it supports a higher multiple. And when you have something like a Titan's thesis, you can shoot for the A+ multiple. Doesn't mean you're going to get it, but hey, the better you're prepared for it, the higher the probability that you have. A well-documented business is easier to buy and grow. That's just straightforward. What's the difference between a strategic buyer valuation and a financial buyer valuation? Okay, strategic buyers, they value your business based upon synergies like cost savings, market expansion, and cross-selling platform and opportunities. Financial buyers, they're going to be something like private equity. They value your business based upon cash flow, growth potential, and return on investment. They're a numbers company. Strategic buyers often pay higher multiples because of the added value that they can unlock. This, for some companies, is going to be a platform company. Financial buyers tend to be more disciplined and data-driven in their pricing. They're going to have an Excel ratio that they're going to take a look at, and they're going to say, this is how much we're going to give you, and it's going to be to the decimal. You want to understand both perspectives because you can position your company. When you go to sell, you can call private equity and say, how do you value business? And some of them will tell you. And some of them are going to be friendly. And some of them are going to be stodgy. And then you got some decisions to make. Who do I want to sell my business to? Am I just, the only thing I care about is the max multiple? The only thing I care about is how much money I'm going to get? Or do I worry about my employees? This is a personal decision. I can't tell you what to do. I can give you some advice and say, here's your opportunities. But at the end of the day, there's answers that you have to figure. How do I evaluate whether my business is valued correctly before accepting the offer? If you're taking the time 5 years, 4 years, 3 years, 2 years out in advance, you're tracking the market, you know your numbers backwards and forwards, you've transferred owner dependency and risk, you've got monthly recurring revenue, you've got client concentration figured out, you've got your standard operating procedures figured out, your org chart, your decision matrices, you have a higher probability of getting the maximum multiple. And so my belief is this: your seller's thesis or your Titan's thesis should say what you expect for your multiple. Like, hey, I've been tracking this for the last 5 years. Here's the history of my company. We've had increased sales year over year. Industry standards 10%, we're at 20. We are a premium company. We have a longevity here that the average employee stays here for 13.7 years. In the market, it's something like 4. Our average client stays on board for 22 years, where in the market, it's 3. Like, when you have that type of proof, then you know that, hey, I deserve the maximum multiple that I can get. Otherwise, what's going to happen is you're going to take an offer. Just take a number. You want to be positioned correctly so that you can have this conversation. You want to know your EBITDA. You want to know your numbers. When I work with a team, one of the things that I will say is, like, anybody who's on the team better know the numbers backwards and forwards. Right? So if we're sitting in a meeting and they say we're willing, we're going to change the multiple from a 6 to a 5, anybody in that room that's on the team that has privy to the information can go, that's a $1.5 million gap. Like, that's not an insignificant sum. Where did this come from? And whoever's a spokesperson on the team is the one that talks about it and asks the questions. What financial metrics does private equity firm use to value a business in the $10 million to $250 million range? Private equity is going to heavily focus on EBITDA margins, revenue growth. They also look at things like cash flow consistency, client concentration, reoccurring revenue. What they're also going to look at is some of the marketing costs and the metrics that come for client acquisition, lifetime value, and churn. They want to know that, hey, what is it going to cost for us to buy a new client? How long is that client going to stick? And what type of profitability they're going to bring to us in the long term? They look and say, hey, is this company scalable from an operations standpoint? Can we figure out what the downside is going to be early on? They really want to measure the risk versus the return and how quickly they can get their money back. Depending upon the private equity firm's thesis, they may have to sell in 5 or 7 years or 10 years. So asking, hey, what is your thesis when it comes to your private equity firm, and what type of numbers and time frame horizon are you running? How does revenue growth affect the multiple of buyers willing to pay for my business? So I want to help you demystify a few things. People will say, hey, before my business is sold, I'm just going to go add a whole bunch of revenue. Well, there's a ratio between revenue and profitability. And the people who've been doing this for a while can look and say, hey, this process, the only thing that you've cared about at this point is to prove that you have a higher revenue. But the profit didn't go with it. It actually declined. And when you take a look at what private equity, an investor or private group is going to pay, they're going to say, what is the quality of profitability versus the revenue? And when you start figuring out, hey, if I can grow my revenue and my profitability, and there is a ratio to it, and I can prove it, you have a chance of getting a higher multiple. Long gone are the days where somebody just grows their numbers towards the end and gives the final push off and says, I want as much money as I can. A good strategic analyst is going to take a look at it and say, hey, no, there's some problems here. Like, there's room for growth, and we'll give you a little bit more, but not the number that you were hoping for. What's a holdback, and how does it reduce the real money I receive when I sell my business? I'm going to give you easy numbers for this process. Let's say that you have been offered $10 million and you have an A+ level company, and you're shooting for the maximum multiple that you can get. And you have all the things in place needed for this company. You've got a management team with transferable knowledge. You've got decision bands. You've got standard operating procedures. You've got org charts. You've got diversified client base. You've got monthly reoccurring revenue. Well, on an A+ deal, it may be like a 95-5 deal, where you would get $9.5 million today, and then they would hold $500,000 back for risk. And let's say you're missing a couple of those things, and they go, we'll do a 90-10 deal. We'll give you $9 million today, and we're going to hold back $1 million. And whatever we lose is we're going to take out of that $1 million, and then we're going to pay you the difference. So there's going to be some losses. And this is why you want to have an exceptionally ran company, is because that holdback typically is a year. Sometimes I've seen it as 2, 3, 4, 5 years, depending upon how the deal is structured and how much risk is in there. So the best option is to get as much money as you can up front with the least amount of holdback, and that's going to take some work on your part. That's why it's a good idea to start looking 5 years, 4 years, 3 years, 2 years before you're selling, preparing so that you can shoot for the max multiple. Is it a guarantee you're going to get it? No, because there are no guarantees in life. But is it a higher chance of ability that you could? Yeah, absolutely. How do I know if my industry is trading at a premium or a discount multiple right now? Well, you can go to the BVR, which is the Business Valuation Report, and look up your industry. You can go to PitchBook. There's a lot of people who publish what the current multiple is. Sometimes, like when a friend that has a company sold, there's a non-disclosure agreement, and they can't tell you. But they might give you a range. They might say, I got between 10 and 15 for my deal. So sometimes people will talk, and without breaking an NDA, they might give a range. I'm not saying it's recommended, but I've seen people do it. You can go online and say, hey, what right now is the multiple for roofing? What is the multiple for med spas? What is the multiple for automotive repair shops? And you're going to be able to figure that out. And then what you can do is you can take your profits, your EBITDA, your earning before interest, tax deductions, and amortization, and start multiplying it just off of your books. Sit down with your accountant, sit down with your CFO, and say, hey, what's our EBITDA at? And the number starts at typically 4 or 5 above 10 million in revenue. Okay, so let's just make it a 4. You had $1 million in profitability, EBITDA, and it's a 4. That should be around a $4 million deal. It's a place to start. If it's a hot market and they're like, we're at 7, what's a $7 million deal? But if you're a platform company and you've got all the bells and whistles that go along with the business, you could get 10, 15, 20. It's really going to depend upon the buyer and what they're trying to do with the business and the direction they're trying to take it. What's the difference between an asset sale valuation and a stock sale valuation? Now, this is where I have to inform you, I'm not a tax accountant, attorney, marriage counselor, or therapist. And when you start taking a look at tax implications, there are conversations. So what typically happens is because of the way that taxes are done when the business is bought, you may get more money for an asset sale. On your end, depending upon how your taxes are done, talk to a qualified professional, you may have less taxes due if you do a stock sale and you've held the company. You want to look at section 1202 of the IRS code. Once again, not a doctor, attorney, marriage counselor, or therapist. Talk to your accountant because it does play a part into your taxes. And so when you start taking a look and saying, hey, I'm planning on selling my business 5 years, 4 years, 3 years, 2 years out, you can be strategic. And one of the things that you're going to want to find, and this is the hardest part of the team to find, is a tax accountant, okay? A tax law accountant. So they have a JD, a Juris Doctorate, and they've got a CPA license. And so whatever a CPA charges in your city or your town that's high end, double it. So if your CPA that's in town charges $650 an hour and your attorneys charge about $650 an hour, you're going to be paying $1,300 an hour or more. And you got to look at this as an investment because when done right, a tax attorney, accountant, CPA can help you protect your money. Now, once again, find one because they're the hardest to get. They're the hardest to find one that's going to be strategic. Somebody who does a bunch of M&A deals and it does tax accounting and tax law is going to be your friend because they're going to help you write your seller's thesis or your Titan thesis. And I promise you this, whatever time you think that it's going to take to find this person, double it. It can take you up to 18 months. You're going to want to talk to a couple of them. This isn't like, hey, I'm just going to pick the first one that I got. And the difference between an asset sale and a stock sale valuation is going to come down to your thesis and what you demand and your conversation with a tax accountant attorney. How does customer loyalty and retention rate affect the valuation of a service business? Service businesses typically have monthly recurring revenue. They typically have some sort of contract. And so what happens is there is a value associated to that client for every one of the services provided. And so some companies may say, you have to perform 2 or 3 services for it to count for you to get the valuation for that client, or we're going to charge you 1, 2, 3, 4 times the annual revenue of that client, and so we're going to pull out of your holdback. So If you were going to get $10 million for your deal and you had a 10% holdback, they're holding back $1 million. And based upon their numbers, you lost $500,000 in business. At the end of a year, they're going to cut you a check for $500,000. So client loyalty is huge because you don't want to have churn. Retention rate is huge because you don't want to have churn. You're going to get dinged and dented for it. You want the least amount of dings and dents on the way out possible. It's your money. You should get as much of it as you can. The more processes and planning that you can put in place to prove the quality of client retention and prove the quality of earnings, the more money you have a potential of keeping. What's the single biggest thing I could do right now to increase the value of my business before I sell? Here's what it's going to come down to. You want to increase predictability, repeatable cash flow, while reducing risk. All the risk that you can take out of your business, the better off you're going to be. It gives you a better chance to get the maximum multiple. The more risk you have, the less multiple that you can get. This means you want to improve your EBITDA. You want business systems. You want to remove the dependency upon you. You want to focus on making the business transferable and start scaling it. Because whoever is going to buy it wants to scale it. So why not have everything in place for them? You're going to find that buyers pay more for certainty than the potential of what's going to happen in the future. They can pay for potential, but you're going to get more money for certainty. If your business runs clean and predictable, your valuation is going to rise. That's just straightforward math. Here's the thing. It's going to take work and effort on your part to get the maximum multiple or close to the maximum multiple. It's your money. You might as well get as much of it as you can. Mahalo for listening to the Scott Sylvan Bell Business Growth and Exit Strategy podcast. Here's what's available to you right now. First, subscribe to this podcast so you get every framework we release. Second, visit scottsylvanbell.com to access the Sell Framework, Scale Framework, and Driver Test. All free with complete scoring guides and implementation worksheets. Third, subscribe to my weekly newsletter, The Party, where I break down strategies and frameworks you won't find anywhere else with one actionable insight every week. Go to scottsylvanbell.com and enter your email. And if this episode added value, share it with another business owner building a $10 million to $250 million company. Until next time, keep building companies that command maximum multiples. Aloha.